Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The key feature here, much as in other grain markets, has been the monthly key reversal up in July. We also had here a similar late March to early July shallow bullish shift pitchfork as seen elsewhere. And as elsewhere, I have retired this pitchfork this week as it is no longer valid, as the market exceeded and moved higher over the upper time. The reason for the move up goes back to the drop in early September. This fall was eventually halted at the time by the odd combination of the rising short-medium moving average, currently at 760, and the lower time of the late March to July bullish Andrews pitchfork, currently at 787. If that wasn't enough, just below was also at the time the rising medium moving average, currently 726. What that meant was the market was halted and turned back up 8 weeks ago. In the process of moving up, the market created a small reverse head and shoulders formation over the late August to late September period. The market initially broke up through the neckline, and this breakup led me to placing initial target X in the 776 area and a secondary target X1 in the 793 area for this reverse head and shoulders pattern. Last week the market reached target X, and this week the market pushed up to, well, last few weeks the market's already reached up to target X and reached up to target X1. They've already been achieved, and I'll retire them after this commentary. The more recent scenario that caused the move higher was the same as in Chicago wheat. The market was getting heavily squished and prices broke higher, slowing and pulling back the first time from the middle time of the bullish Andrews pitchfork, currently at 838, then recovering and having another attempt higher last week, and in the process creating a weekly key reversal up. The follow through to this weekly key reversal up has been limited, but it is worth noting that prices have moved above the middle time, are now seemingly gauging the next resistances above. Mostly they're from 2014 between 853 and 862. Does this market have the strength to overcome these resistances? Well, it would seem a reasonable idea, but it would erode at least some of the bullish incentive and also cause concerning patterns such as yesterday's possible shooting star pattern to occur. To counteract this bullishness, well, you'd need to at least break, and I don't mean pierce, I mean properly break the lower time, currently at 787, and that seems an unlikely solution right now. I'll just leave you with a quote I made 5 weeks ago to finish off with. Just be aware, all this is in the shadow of July's monthly key reversal up. End of quote. Minneapolis wheat. I have in the past really admired this contract, as it was a series of brilliant pieces of technical action, and I had repeated the same mantra now for months, literally months. However, we're now starting to see some fraying, some considerable fraying in the long-term technical patterns that have been evident here since early April. Now, that doesn't mean that these long-term technical patterns are dead. No. It just means what I say, that they are getting a bit frayed. The key and supremely important pattern here is the December 2020 to early April bullish Andrews pitchfork. This pattern has run this market higher so successfully, and it was, and is after a fashion, still valid here, though you would have to allow for some of the aberrations we've seen over the summertime and also more recently. What has recently happened, though, over the last 4 weeks or so, is that though the bullish incentive initially took an even stronger turn, piercing and closing over the upper time, currently at 1042, making a concentrated move higher, but then finding more acute angle to be too much and dipping back below, admittedly a small one, but a small bearish downtrend that it created, currently at 1053 over the last 3 weeks. This is the first bearish trend line since September, and is also increasingly looking similar to what happened back in July and August. Now, I pointed out 3 weeks ago that the issue in any sharp rise here is that we have some significant resistances overhead, specifically the July 2012 high at 1034, the May 2011 high at 1055, and the May 2008 high at 1083. It seems the market has now met most of these resistances, and the result has been a stalemate of sorts, neither going higher nor heading lower. Below we now have an interesting support congestion area between 986 and 974. This congestion area is made up of the 50% absolute Fibonacci line at 974, the November 2012 high at 977, and the September 2012 high at 986. It'll be interesting to see what will happen should we see the market choose to test down there, as the middle time will start moving up through this area next week, thus possibly strengthening it. I'll finish again with my last words from 3 weeks ago, and I quote, "All things come to an end, and perhaps, just perhaps, these recent actions are the first inklings that the original December 2020 to early April bullish Andrews pitchfork is heading that way." End of quote. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.